Right now, it's time to bring in our first guest, a repeat friend of the income generation, Gregory Daco. He's the U.S. chief economist at Oxford Economics, and he's responsible for producing the U.S. economic outlook using their proprietary global economic model. Greg, thanks so much for being back with Jeff and myself here on the Income Generation.
Greg, it's great to see you. Hey, listen, right out of the gate, I want to hit you with the Fed's new business model, which is inflation. Devaluing currency, create as much inflation, as much consumer demand as possible. What's the story? When does this peak, or when do we have to worry about this asset bubble exploding?
Well, I think what the Fed is intending on doing is essentially sustaining as strong of a recovery as possible. So essentially ensuring that it does not tighten preemptively in terms of ensuring that recovery that is strong and sustainable. And it wants to, as a reminder, generate as broad and inclusive employment gains as possible. So it's not going to react preemptively to higher inflation, and will want to remain with policy as accommodative as possible.
So consumer demand is off the charts, though, in this low rate environment. Do you think that is going to continue?
I think so. I think we are likely to see a real boom in terms of consumer spending activity in 2021. It's going to be supported by three factors. Number one, a better health environment with increasing vaccinations across the US. Number two, an environment in which the weather is going to be improving, and therefore service sector activities are going to be rebounding. Number three, of course, a big fiscal impulse from the American Rescue Plan.
And so what kind of expansion in GDP are we going to see year over year? I mean, they're talking about the greatest expansion post-World War II. That's a big number. What do you think we're going to see?
I think we're going to see growth around 7% this year. We have growth at the end of this year around 7.2%. That would be the strongest performance for the U.S. economy since the early 1980s, 1984 to be precise. We're also likely to see 7 million jobs being added to the U.S. economy, an unemployment rate with a 4% handle by the end of the year, and a little bit higher inflation. And that's going to be something that the Fed's going to want to monitor very carefully.
Greg, that's amazing. 7% is going to put the economy far ahead at the end of this year compared to where it was at the beginning of last year. But Greg, don't go away. We're going to continue our conversation later in the show. And coming up after the break, we'll talk about other ways that the income-based investing model can help you play good financial defense. Stay with us. We'll be right back on the Income Generation. Now it's time to bring back Greg Daco, U.S. chief economist at Oxford Economics. And Jeff, you seem to be on a roll, so take it away, my friend.
So Greg, I kind of think like we've seen this show before financially in terms of all the fiscal and monetary stimulus. And this stuff is just record-breaking, the amount of money we're spending, and the deficit's over $3 trillion a year in terms of what we're doing. But the reality is at some point that stimulus has to stop. It can't go on forever. So give us what the window looks like on that.
Well, I think when we look at the fiscal impulse for the U.S. economy, and we look back at the last 3 months, we've had essentially $900 billion of COVID relief from the package that was passed at the end of December, plus $1.9 trillion from the American Rescue Plan. That should combine for a fiscal impulse of about 4.3 percentage points this year, but that's going to fade away. Less fiscal aid will be available going into 2022, unless, of course, there is the Build Back Better investment plan that Biden has been talking about, which could be another $2 trillion over the next 10 years.
That's crazy. So basically, I think you're talking about the stimulus package or the infrastructure package of around $2 trillion that they want to build, correct?
That's correct. The Build Back Better plan is essentially geared towards increased infrastructure spending, research and development activities, tax incentives for green energy. All those investments would total about $2 trillion. Now that's over 10 years. So that's important because that would lift the potential supply of the US economy. And that would actually be a long-term gain for the US economy, which would be less similar to a one-time shot in terms of fiscal impulse.
But the stimulus side of the equation is, at that point, maybe they start to taper off and demand starts to stop. So when does this pop? When does the stimulus bubble pop? And when do we start to destimulate the economy, so to speak?
Well, I think in terms of short-term stimulus, we're going to see much less of that towards the back end of this year. Even some of the stimulus and the aid that is being doled out right now is based on the number of people that are unemployed. And hopefully, over the course of this year, we'll add about 7 million jobs. So there will be fewer unemployed individuals, and therefore less aid will need to be provided to the people that unfortunately have lost their job. So less fiscal stimulus towards the back end of the year. But again, this prospect for more supply side growth with greater investment spending as part of the Build Back Better plan.
So, Greg, let's talk about one of my favorite topics because we're hearing about it all over the media today, and that is inflation. Things are in hot demand. Prices are going up. Energy prices are spiking. Prices for pressure-treated wood are $6 for a 2x4. It's crazy what's happening. So give us your picture on inflation. Is it real?
Yes, inflation is real. It's actually unavoidable. An environment where you see stronger demand, in particular stronger demand for goods, you're going to see firmer inflation, and we're already seeing that. The key question is whether it's controllable, and I think it is controllable. We will see higher inflation going into the next few months with some favorable base effects relative to last year, with some push up from energy prices, and with fiscal stimulus stimulating demand. I don't think, though, we will get spiraling inflation, which would be a key concern for the Fed and for the broader economy.
So what happens to inflation, though, Greg, when consumer demand starts to wane, taper off, or contract?
Well, that's actually an endogenous brake on inflation. When you see prices rising too fast, then it tends to weigh down on demand. If inflation then it contracts or slows, that is actually a good thing for the economy. The key risk is that inflation expectations become unanchored. And that would be a phenomenon by which people expect inflation to keep accelerating and therefore pull forward their demand because they're worried about hyperinflation. That's not going to happen in the US. I think we still have a lot of factors that will keep inflation under control, but inflation will certainly be a lot warmer than it's been over the past decade.
In 40 seconds, tell us what your factor is on interest rates going forward over the next 24 to 36 months. Will we see a non-organic move in rates?
Well, I think we will continue to see the reflection of stronger growth, that reflationary trade with long-term yields rising over the next couple of months. But I think the Fed will maintain a strong anchor in terms of short-term rates, and we're likely to see short-term rates remain at the effective zero lower bound for the next couple of years.
Greg, thanks so much for being back with us. It's awesome. Jeff, great interview. Thanks so much. I love you, bud. And that's it for today's show, everybody. I hope you learned a lot about investing for income and how interest rates affect investing for income and what strategy you should be taking.